The instinct from yesterday came from my old days with Jim Cramer, just watching him trade. We all knew that the day Elon started Doge, you should have been worried about that for Palantir. That wasn't the problem. Everybody knew that. The problem was somebody on Wall Street panicked. Somebody said, you know what? I'm up a lot on this Palantir. Things are looking a little shaky out there. I'm going to sell it. I need to move 5 million shares of Palantir right now. The reason for him moving to Palantir is whatever. But the point is, the same story exists with Carvana, with HIMS. Stocks are up a lot. Guys are up big on these trades. Anything that's been up a lot and people want to protect their profits and sell, they're going to do that to the other stocks too. So you have to go hit the other stocks before the shareholders hit them. You know, there's a guy at Fidelity, let's say he's not even overweight Palantir, but he sees his boy, he doesn't even follow the stock, okay? But he sees his boy down the hall shouting about Palantir dropping 10%. You know, Fidelity owns $5 billion of Palantir. He just lost $500 million in 20 minutes. He's looking at his portfolio and saying, what do I need to get out of to not have that happen to me? Right? And it's probably something like a HIMS or something like whatever. He looks at his portfolio and says, all right, you know what? Let's sell my HIMS. Let's sell my Dutch Bros. You know, maybe he's a consumer guy. Let me sell my, what else? What other consumer stocks have been up a bunch? Sell my Celsius. Yeah, it's not been up a bunch. But, you know, whatever consumer stocks have been up. And, you know, this is just trading. You know, you want to take advantage. You know, there's an old, I probably shouldn't say this. There's an old guy from SAC Capital before it was _72, and he worked for Steve Cohen. I think he still might work there. He'd been working there for 20, maybe 25 years. And he had a saying where he said, my job is to predict what the bigger players are going to do. I basically am trying to predict what Fidelity is going to do. Fidelity, you know, is the biggest actively managed fund. And, you know, they basically are buying 5 to 15% of a company at any given time or selling it. And, you know, that's the guy he's trying to play poker with and get in front of. It takes Fidelity 3 days to get in and out of stock. Right? That's why you probably could have shorted Palantir yesterday. And that's also why traders are always trying to get flow on Wall Street. You know, this is why you pay Goldman Sachs. This is why you pay Morgan Stanley. When you trade on Robinhood, you don't get a call from Vlad Tenev that says, thank you for your trade. By the way, Fidelity's selling a bunch of Palantir. Now, they're not allowed to tell you exactly that. So they might say, big mutual fund selling a lot of Palantir. But when I call with 5,000 shares, they say, well, thanks, Martin. Love the farmer, bro. See you later. Hangs up. But when Steve Cohen calls and he's trading 500,000 shares, they'll say, well, by the way, I think a big player's unloading all his HIMS. Then he calls another broker and says, hey, short 1 million HIMS. You know, that's how the game is played or used to be played. Things have changed a lot. But there's still stuff like that still works. And that's, you know, old school trading desk stuff. You know, being able to surf that, you know, wave of hype is almost impossible. We've tried it here 100 times, right? You see the hype, you see it cresting, you know, almost, okay, sell it. You know, that's what we're always trying to do, right? Everyone wants a shortcut. The reality is, like, to find good investments, you just have to look at massive amount of stocks, listen to massive amounts of conference calls, talk to massive amounts of people. That's really the problem when you see bag holders. Like, the number one sign of a baggie is they have one stock and that's all they care about. That's the number one sign of a baggie. The biggest returners of last year, you didn't look at because you're lazy, and you should have looked at AppLovin. I don't see why. I don't know AppLovin. Yeah, on even in crypto, like looking at every crypto, finding the very best short, like Vine. Vine was hilarious, man. Jesus Christ, 6 cents. Well, when you deal with big losses, I think that the basic approach is to keep perspective in life and what matters to you. And, you know, there are people that lose their family members. They lose their health. They lose things that you can't get back. Those are the things that matter. Losing money, well, you know, you can make money again.
It's not that big of a deal, especially if you're talented. Now, if you're not talented and you had a lot of money and you lost it all, well, one way to have some solace there is to say, well, maybe I shouldn't have had it in the first place. So, but if you're talented, the money will come back very quickly. Buffett said a lot of the same things. It's mostly a psychological game. And my psychology is interesting. I mean, I've been able to like just deaden most emotions. But that doesn't mean that I make all the moves correctly. I don't. Listen, I mean, the famous investors, look, every person, no matter how smart they are,
𝗬𝗏𝗘𝗙,
they're subject to Dunning-Kruger effect. Every person. Everybody becomes a quick expert and stuff. And the reality is most people, they know a little bit about one thing. They think they know a lot about it, but they don't know that much about it. On things they don't know much about, they think they know a little bit, but they really know nothing. And this includes me, by the way. I think you have to be really careful listening to other people. But one of my favorite ideas in just thinking, period, that I've ever sort of had, that I love. One of my favorite ideas that I've ever come across in thinking was I was reading a chess master's book on chess. And you know what? Actually, it was the foreword. It's the foreword to My System by 𝗂𝗂 the modern version of My System. Not the 1920 copy, but the 2020 copy. I don't remember when this was. So in any event, I'm reading 𝗂𝗂's foreword to My System. And it's a really funny thing because, you buy a chess book and you're hoping to read it and get really smart. So I'm reading the 𝗂𝗂 foreword to My System, which is sort of this classic chess book, but it's very old. And so 𝗂𝗂 writes in there that like when he was a kid, he read My System and he disagreed with most of it. So you sit there and say, well, why am I reading this chess book? It's useless. But he said that it got me thinking about chess. And I thought about chess in new ways that I hadn't before. And even though I didn't agree with everything in the book, I sort of started to think about chess in a new way and consider, new styles and what he was saying and well, why do I think it's wrong? Can I prove that it's wrong, et cetera? And so the point is that, when you listen to some of these people talk, and that includes me, you have to sort of use their thoughts as sort of a muse for your own thinking. Never, ever take anything on face value. Now, you might listen to their thoughts and say, that makes sense to me. I agree with that. Or you might say, he's not considering this, or I think he's a little too emotional about this, or whatever the case is. You have to decide why you think it's right and why you think it's wrong. But there are no manuals in life. There's probably a couple of situations that's close to a manual, but in your big open-ended games where there's a lot of imperfect information and you need a strategy, chess, markets, pickup artist, be fairly fluid and malleable. I mean, I think I'm fluid. I'm open-minded. I don't think I'm dogmatic, but I do have a system. So I'm not so fluid that I'm going to buy Fartcoin if I think it's going up. I think you have to have a system and you have to have conviction, but I'm fluid within that system. I think it's a mix of instinct. In fact, there are very few women traders on Wall Street. And there's this famous case of this guy who worked for Steve Cohen, who's, kind of like the king of hedge funds. They made billions a little bit, I think, about him. And there's this guy working there, and he tried to make all of his employees, like the people under him, take estrogen to become more like a woman because he felt that women were better traders than men. They were less emotional.
Because they have feminine emotion. What do you mean they're less?
That's what he was thinking.
Emotional? They're maybe less sentimental, right?
Yeah. Like if I get angry at a stock, I'll start to like take my anger out on it. And that's a really terrible, stupid thing to do.
And women like to lay in wait. They like to hold.
Right. Women are like, I'll have you over when the time is right. I'll wait. Right, look at that. 50% of revenue is net earnings. After tax, 50%. How many companies do you know have 50% net margins? Net margins. So, well, it gets worse because what people will do, I hope you guys are paying attention. What people will do is they'll do some cardinal sins here. So this was year ending, let me do this right. 7/31/24. 7/31/23, 7/30/22. This was 10/31/24. Stay with me, pay attention. This is really valuable right here. It's just like a lot of the fallacies, follies, and idiocies that come with growth stocks. A lot of people don't understand growth stocks, and you cannot be a good investor. And Buffett proved this. You cannot be a good investor unless you understand growth. It is critical. Growth is everything in investing. Everything. Because growth compounds the same way investment returns compound. Cash flow compounds. Let's see here. Little tedious, bear with me. This is going to be worth it. All right, I'll just do the revenue because that's the point I'm mostly trying to make here. Okay, so I see some of you. I do. I see you and got beef because a lot of people complain about how expensive some of the growth stocks are, like Palantir, but they don't really understand what they're looking at. And I want to help you understand. So here is Zscaler, which is, it's a growth stock. It's not like Palantir. But just look at these last 12 months. That's called TTM, trailing 12 months, right? What's the trailing 12 months? That's 2.3 billion total, okay? What mistake did I just make? What mistake did I just make? Well, I'm just trying to get a number. Yeah, exactly, Pascal. If you're looking at the last 12 months, you're really, in a growth company, you're really ignoring the growth the company has. In fact, you should be looking at the next 12 months, or just annualize the current quarter. But there's a couple ways to do it, but looking at the past is really just not the way to do it at all. So the trailing is 2.3. So let's look at, so it's a trailing revenue. So a noob might look at this and say, okay, I'm going to use the trailing revenue to somehow divine something meaningful. Someone slightly smarter might look at the run rate. So what's the run rate? That's 628 last quarter times 4. Well, that's a little better. That's 2.5 billion. If you're really smart, you look at future 12 months, basically, your next 12 months, and you'll take the run rate and you'll multiply it by their growth rate. And now you got 3.26 billion. That's still not the right thing to do, because what we really want to look at is free cash flow, because unless we know the margins, price to sales means nothing, right? So now let's look at free cash flow. Well, free cash flow for 2024 was 635. Again, not maybe the smart thing to do. You could try the run rate, which is 314 times 4, but you're still getting not really a great number, because you want to look at the growth of that. This is maybe the real number. So look at how different each of these pictures are. This gives us 14 times sales, which doesn't sound so great. This gives us 13 times sales, and this gives us 10 times sales. But even 10 times sales, it sounds kind of expensive, right? Well, it's not, because now let's look at the actual earnings. Well, if we look at last year's free cash flow, 50 times earnings doesn't sound so great. If we look at the run rate, it's 25 times earnings, which for a 30-40% revenue growth company is great. But if even better, next 12 months cash flow, 17 times earnings for a company growing like crazy. And so you can go from like thinking it sucks to thinking it's super cheap just by changing your frame. Adjusting your frame of what you're looking at. Yeah, I mean, debt just goes into enterprise value, which is why we use enterprise value instead of market cap. In this case, they're very similar. So it looks like a great company, even if the product isn't fantastic. But we have to worry about other things like, is this company saturating their opportunity? You can see growth is, I always talk about the second derivative. The second derivative of growth is negative. It went from 40% growth to 35 to 32 to 30 to 26. Are we going to see this growth rate continue to drop?
It doesn't come down to knowledge and plenty of MD PhDs on Wall Street. it's more about logic. I mean, there's plenty of people who can, become a researcher. They go through the motions to do it, but they're not necessarily always logical. Human emotions and bias cloud much judgment. People get very addicted to a research hypothesis. Again, think of the market as a linear combination of factors. And if you ask yourself, that's kind of what we did yesterday. We said, well, what factors, who has a momentum factor? HIMSS. And if momentum factor is going to go for sale, shorting anything with momentum factor. Zscaler has some momentum factor. So does any stock that's been up a lot. That's momentum factor. I don't know if Bitcoin will hit 300K by end of the year. That would require quite an interesting set of macro scenarios. I think it's more likely Bitcoin either stays flat or drops a bit. I can see it go up a bit. It's pretty unlikely, but my net kind of assumption is Bitcoin sort of fades to like 75K-ish. What'd Berachain do? Ooh, wow, Berachain jumped. Yeah, people are DMing me in the middle of the night like, should I be shorting Bera? Like, man, let me get some sleep, man. Yeah, just linear combination is just, the basic linear algebra idea that you have some coefficient sort of explains every factor. So here's a 3-factor model. For every stock, by modulating the coefficients, you can adjust alpha, beta, and gamma, right, to equal the stock change, delta. So these are the 3 factors, X, Y, and Z. X, Y, and Z. And now there's infinite number of factors, but we were focused on the momentum factor, which is basically how much has the stock been up or down lately? Does it have positive momentum or negative momentum? It's almost like the second derivative too. Y could be something like quality. This is a high quality company, Palantir's high quality. Or is it a low quality company like QUBT or SEAL? How about the industry? That's a factor. Country is a factor. So many factors. Management quality, diversification. I mean, there's so many qualities. So you just keep adjusting these weights and you can impute what's happening to these factors. And you can basically price every single stock. And this is what hedge funds do. You make the best factor model, you make the most money. Get that bread, young blood, get that bread. Early Renaissance was factor models. If you want to go read the book, there's a little bit of clues in there. There's a lot of clues in there. The Man Who Solved the Market, a couple of clues, check them out. It's not going to give you the whole system, but just crossing the bid-ask spread is enough for these quant funds to go from profitable to unprofitable. So you got to keep in mind that a 5% return with a 0.5% standard deviation is the go. You may not see it as a big return, but if you lever that SOB up, it is a huge return. I'll be right back with this.
Oh, okay, so AD, let me help you out here. I want to make sure you understand. Your YOUR is different from YOURE. Now, to people that speak English and read and write frequently, this difference does not need to be thought about. It comes automatically. It's second nature, right? We also don't need to think about there, and there. You start to get used to it if you speak and write a lot of English, if you read and write and you've worked at some point in your life. So this, but the bottom one here means you are. You tried to say I was lame, you're lame, but you spelled it with this one. This is your things. This is a possessive. So like your brain is diseased, possibly from Adderall use. I don't know, but that is your brain. Or your career is not good because you can't spell. You are going nowhere in life. You are a failure. That's this part. That's over here. So I'm just helping you out there. Okay. Skitty, stop it. Yeah, you can't seriously think that today's margins for a company in a hyper-growth period are relevant. You're LARPing. You're coping that the company has gigantic revenue growth. Scale, I mean, when you're growing like that, you're investing. You're overspending. And when your company reaches closer to a steady state, then you worry about your margin structure. You ever run a company, you know this. No, when you're really growing fast, you're going to spend some you're going to have some expenses that are just not going to happen once you get bigger, or they're just not going to scale the same way once you get bigger. The company's still growing very rapidly, so talking about Palantir, it's almost completely a software company. Consulting is a very small sort of part of that. Yeah, I mean, just look at the gross margins. Gross margins always matter, of course. Palantir has high gross margins. I mean, look, I'm not saying I run my company like that, but it's a strategy. It's worked. It's worked for a lot of companies, including Amazon and others. Yeah, gross margin's 80%. They've accelerated their growth 2, 3, 4, 5, 6, 7, 8 quarters in a row. Their growth rate has gone up. That's pretty unprecedented. They're doing something right. Assuming that continues, I mean, $5 billion in revenue should be in the bag.
I think that like one time the feds were trying to entrap me. We were just starting touring pharmaceuticals, and we got this weird call from like somebody who like I don't even think they would leave their name necessarily or their number. They were just like, "Yeah, I'm interested in investing." We're like, "Great, you know, this is the drug we're developing. This is this is that." And they were like, "So it sounds like you're telling me there are no risks." And I go, "No, there's risks. There's risks of the entire investment will be lost. This is drug industry is very risky. The drug doesn't work. We lose a lot of money." Like, okay, but you would say the risk is really low, right? I was like, no, risk is low. Risk is high. It's a high risk, high reward industry. I just could have sworn it must have been FBI. Because like the way they kept like trying to get me to like, so, you know, this is like a guaranteed thing. And I go, no, it's not a guaranteed thing. Why do you keep saying that? Like, what guarantee? Am I making you a guarantee? Are you hearing me right? Like, this is a good chance this doesn't work out. You know, my track record is good, but it doesn't mean anything, really. It's just a really funny and weird thing. Azul, investments in startups are extremely risky. Most investments in startups go to zero. You got to be prepared for that kind of rate of failure. If you've never invested in a startup before, I don't want to be your first. Some people care, some people don't. You know, in this role where I'm trying to help you guys with your careers and your life, I do think if I were you, it's important to know these names and these players, because these are the only people who have jobs as professional investors. So you want to work for a top professional investor, well, you got to know who they are in the first place. You've never heard of them, then, you know, I always give the example. Let's say you're on a plane or you're waiting for a bus. It doesn't matter. You're on the subway, and for whatever reason, you strike up a conversation with somebody, and maybe they touch your leg, but you find a reason to start talking, and you're like, "Oh, so what do you do?"
𝗕𝗏𝗘𝗙.
And they're like, "Oh, I'm an investor." And you say, "Oh, wow, you know, what kind of investing do you do?" "So I work for a fund. It's called Anson." And if you're like, "Oh, never heard of it," then you like could totally throw away your, you know, chance. But if you're like, "Oh, I loved your short on this stock, you know, on SoundHound. That was a great short you guys did." And he's like, "Wow, you really know a lot, huh? Yeah, I'm friends with so-and-so. You know, I'd love to stay in touch." Or you don't even say that. You come back next week and you give him a call and you say, "Hey, John, it's Steve from the train." "Oh, what's up, Steve?" "Yeah, you know, I was looking at this other stock. I think it's a great short." "Oh, yeah, tell me about it." And now you've got a networking opportunity. That's how you do it, folks. But you got to hustle. If you never even know who the names are, you're not going to have a chance. Oh, there's funds and stuff. I mean, listen, if you're not in New York, don't waste our time. Want to be a top investor from Kansas? I mean, you got to go find the 1 or 2 guys in Kansas. I mean, they're there. They're definitely there. But you got to go find the 1 or 2 guys that invest out of Kansas. There are not that many. Yeah, I mean, how many investing jobs are there in Omaha? 6. Yeah, I know you can make it. There's money everywhere. But you want to work in the professional investing career, hard to do it on your own. And Buffett came to New York. Buffett worked in New York for a while. I mean, Chicago, San Francisco, New York, Miami. There's plenty of cities you can do finance in, but you're in Kentucky. You know, how are you going to join the hedge fund industry? Yeah, not too much going on in Toronto either. You know, one of the things you have to learn how to do as a trader that I've never loved doing, but I'm 100x better than I used to be, is take losses.
You got to enjoy it. It's like very paradoxical. You got to be like, yeah, I'm getting out of a loss before I make more losses. Yeah, it's great. It's obviously a little not fun to do, but look at how fast SMCI has dropped as I'm sitting here. And again, you know, this is a stock where you might get $1 a minute, and to a trader, volatility is your best friend. Volatility helps you cover up your mistakes. Like in Japan, this is pretty common. That's why I like trading Japan. Like they'll react to the news like
order filled
6 hours later, a day later. They don't care. It's a great market. There aren't people like you and me in those markets, fiending for profits, just dripping sweat, looking for the next trade. Give me 30. All I need is 30 seconds ahead of the market.